Could you imagine a stock market portfolio with millions of dollars in it? Here today, folks, I'm going to give you my top 10 best tips I possibly can to reach to $1 million plus in your portfolio and hopefully several $1,000,000. Okay, this is just a gem dropper of a video here today. It is fully focused on education here today. I've been in the market over 15 years. I've obviously scaled to many millions of dollars invested in the market. I just want to give you my top 10 best tips for everybody out there so you can then achieve what I've achieved obviously over the past 15 years, and hopefully you can do it even in a shorter amount of time. All I ask in return for today's video is for you to smash that like button and make sure you're subscribed here to the channel. That's all I ask in return. I hope you get a ton of value out of this one here today, okay? So, and that's your way of showing me appreciation, is by smashing that thumbs up, okay? So, tip number one is, before we get into the investing part, right, it starts with income and expenses. Income versus expenses. Your goal needs to be to invest a minimum of $1,000 per month. Now, if you're watching this video right now, ask yourself, can you invest at least $1,000 per month into the stock market? If the answer is no, then you've got to figure out, do you have an income problem or do you have an expense problem? Is it you have too low of an income? Do you need to apply for different jobs? Do you need to try to start a side hustle? Do you need to start a side business? Do you need to start your own business? What do you need to do there, okay? Expenses. Do you have an expense problem? Are you overspending? There's plenty of people that have a very large income, but then they add a bunch of expenses to their life that they don't really need. And the next thing you know, even though they're making, let's say, six figures or even multi-six figures a year, they actually can't even invest $1,000 a month because they're literally spending so much all the time on, cars and houses and all this different stuff that they have in expensive vacations. So this is the first thing, okay? If you're in a situation where you can invest $1,000 a month actively, right, $1,000 at least every month, then you're set up in a situation where you can buy at least once, if not multiple times, every single month, which then prevents you from trying to time the market. Because the issue is, a lot of people try to time the market, and if you just have a lump sum, you kind of think, okay, I only have $40,000 to invest and I have nothing else. You kind of like are trying to think, oh, I got to invest at the perfect time because I only got this. If you can actively invest and buy stocks at least once per month, if not several times, now you just remove that whole timing of the market. And we do know, if you try to time the market, you're usually what? You're usually going to underperform the market, okay? So that is something you want to avoid. And by having more income than expenses, you can avoid that, right? Also, this is very, very important for everybody to understand this, okay? If you're able to buy stocks at least once a month, if not several times a month, guess what? Now you have no fear about market crash. One of the biggest things that prevents people from buying stocks or building a portfolio is a fear about, what if it crashes? What if there's a correction in the market? These sorts of things, right? Well, if you're able to buy stocks every month, if not multiple times per month, that removes that fear. You then welcome crashes. You then welcome corrections. You're like, please, because you're in a buying position. No different than, imagine you were looking to buy a real estate property. Would you rather the prices go up another 20% from here before you buy, or down 20%? Of course, the answer is down 20%, right? Because you would rather buy a house for as cheap as possible. Same things with stocks, right? And so when you're in an active buying situation, suddenly you now welcome crashes. You like, I wish that stock would go down. Please send that stock down so I can buy more shares of that stock for very cheap prices, right? And inside the private group, we're all trained to think like this, right? We've had a tremendous amount of folks in the 6-figure, 7-figure club. These folks all think like this. In the Discord chat in there, we're not just sitting around all day like, oh, guys, I'm so scared the market's going to crash. No, we're talking about stocks every day, talking about pros and cons of these different stocks, why, different folks are investing in this stock versus this stock and those sorts of things. We are able to do that because people have more income than expenses. They're not stuck into some situation where it's a lump sum. They're trying to time the market and all these sorts of things. That's a foolish game, okay? You'll end up producing yourself worse results over the time trying to play that game. So get your income and expenses right. Now we can talk, okay? Tip number 2, be confident in yourself. Now, it's easy for me to say, right? Be confident in yourself. But how did I get so confident? Think about that for a moment, okay? Confidence is vital to having success in anything in life. You cannot have success in life unless you're confident that you can have success in that, right? In my head, personally, I think I'm going to be the greatest investor in history. You could put me under oath. You could put me on a lie detector test. I truly believe that to my core. I will be the greatest investor in history. No question. How do you become that confident, right? You become confident. If we think about how confidence is defined, the feeling or belief that one can rely on someone or something, firm trust. The state of feeling certain about the truth of something. A feeling of self-assurance arising from one's appreciation of one's own abilities or qualities. So let's say I wanted to pick up golf, right? Well, how would I gain confidence that I could become a good golfer, for instance, right? And this could be applied for everything in life, including the stock market, which is what we're talking about here today, right? Confidence is gained from a few ways. Asking questions and getting answers. That's going to help you get a lot more confident, right? Imagine you're trying to learn how to become a great chef, and you got a very experienced chef, and you ask them questions. Hey, why you do this certain thing at this time, and why do you only cook that for this long? And they'll explain it to you, and you're like, oh, and that's going to make you more confident, right? You also get confidence through trial and error, through successes and failures. That gives you confidence over time. So you know what failure looks like. You know what success looks like. You know how to identify when you're being successful versus when you're failing, right? Time, practice, experience. Those are all very vital to you getting confidence in yourself to become a great investor, right? And here's the bottom line. The more work you put in, the more confidence you're going to have. That's just across the board with anything in life. I ask anybody that's been at their job 5-10 years how confident they are. They're going to be insanely confident. Why? Because they've been doing that job for a long, long time. Ask somebody that's their first week on the job how confident they are in the job they're doing. They're not going to be confident. They're unsure. They need guidance. They're looking around. They're like, somebody help me out, please, here, okay? So let's say I took up golf and I play 5 days a week, Monday through Friday, and I do that for a full year. I'm going to be super good at golf, right? Like better than 99.9% of the population. But that's all relative. It doesn't mean I'm going on the PGA Tour, right? I'm still scratching the surface. After 1 year of playing 5 days a week, I would still be scratching the surface. There'd still be so much I have to learn about this, right? And I would have gained a ton of confidence in that 1 year, but there's still a lot to go, right? Take me back to this picture right here, Walgreens, 2009. I've been investing for about a year or so. And did I know way more than the far majority of people out there about buying stocks and becoming a good investor? Sure. But did I know nearly as much as I knew right here in 2014, right? When I had been investing for over 5 years at that point in time? No. This Jeremy knew way more than this Jeremy right here, right? And now if I look at myself, 15 plus years deep, I know way more than this guy right here, right? And so that's the name of the game. And at the end of the day, here's a quote for you guys. It's my own quote I came up with, okay? You can't gain real confidence without putting in real work. It's no such thing as that. That's just fake confidence. If you're trying to be confident about something and you haven't put in real work, you're not going to actually be truthfully confident in that. You have to put in real work to actually get real confidence, okay? And so when it comes to this, it's about understanding everything that's going on in the market, understanding financial statements, all the metrics, why they're important, how to value stocks, understanding if you're getting ripped off on a stock, if you're not, and then researching companies, listening to conference calls, those sorts of things, right? And guys, we're talking about hundreds of thousands of dollars and millions of dollars up for grabs here, right? Between a successful investment and not a successful investment. I've made over $600,000 on Meta, put in a lot of work to that company over several years, right? It's a lot of money. There's a lot of money up for grabs here. Hundreds of thousands and millions, and if not tens of millions, hundreds of millions of dollars. So when you're talking about you're playing that sort of game, it pays to put in the work. People thinking about hundreds of dollars and thousands of dollars. That's little money. That's little money. Little money. We're talking about hundreds of thousands, millions of dollars plus in this game. That's why you got to put in real work. It's not small money up for grabs here. It's big, big money, okay? Tip number 3 of 10, margin of safety in valuation makes investing much easier. Once again, margin of safety in valuation makes investing much easier. So this helps you prevent and avoid huge losses. This is why I always talk about the forward P. The forward P is one of the most important metrics, in my opinion, in the stock market, if not the most important metric in the entire stock market. And getting a stock for a cheap forward P or undervalued forward P can be the difference between taking a 50% plus loss on a stock versus, let's call it, getting good gains over the coming years. Such a vitally important metric. There's a million things that are important in this market, but I'm telling you forward P is one of the most important, okay? So for instance, if I look at a stock like Cake, right? Forward P on the stock of around 10. Now, what are the chances a stock drops 50% outside of some sort of epic market crash? I would say insanely low probability because it's trading so cheap. It's trading far underneath where the market trades at. This is 1000xstocks.com. You guys don't have access to this yet. It's a service I've been creating for quite a while behind the scenes, and it goes through massive amounts of metrics, shows you what these metrics are usually trading at versus a stock you're looking into, being able to compare them all. It's a pretty in-depth tool, but once again, you guys don't have access to this yet, okay? If I look at a stock like Chipotle, great company, right? Great company, and it should do great in the future, right? But at the same time, Chipotle is a dangerous stock. It trades at a forward P of 55, which is substantially above the market. So the chances a stock like Chipotle could fall 50% is pretty decent, right? And the chances it's going to go up a dramatic amount in the next few years is a pretty low amount because it's already pricing in so much, because it's trading at, let's call 5x the valuation of, let's say, a stock like Cake, for instance, right? So this is extremely important, extremely important. A stock like Elf, right? A stock that I own, it is a tremendous gainer for me. We made like 2,200% on the stock, right? But the problem with Elf is it trades at extremely high forward PE, right? Versus a market not as high as Chipotle, but it's still very high. So a stock like Elf, if I was thinking about actively buying it today, I just got to understand that I'm taking a risk in a stock like that. There's not as big of a margin of safety. If this company's growth rates slow at all, guess what's going to happen? The company's stock price will get hit very negatively. So let's say instead of reporting 70 to 80% revenue growth, if all of a sudden the company started reporting 15% revenue growth, which, by the way, 15% is still amazing compared to most companies in the market. But if they did that, it'd be such an epic deceleration in the business that the stock would get slashed very, very quickly, and it would lose 20, 30, 40% of its value in a very quick amount of time. So forward P, you really want to look for those sorts of companies that are going to grow in the future, right? That are going to grow in the future in terms of their revenue and profits, but are trading under where the market's trading at forward P-wise. It gives you a much bigger margin of safety there than some of the high valuation names, right? So how I would think about this is high forward PE stocks, they're like a straight A student. The student that is taking all honors classes and AP classes and they get all straight A's, right? From that particular student, perfection's always expected, right? And so anything other than perfection causes panic. If you have a student who always gets straight A's and all of a sudden, let's say that student starts getting B's or C's, the parents are going to freak out. They're going to be like, what? Like, what's going on with you? Or is like something going on? Like there's got to be something wrong with you, right? However, if we think about low forward P stocks, these are like the straight C students, right? If all of a sudden they come in with a B or A, they're seen as glorious, right? They're praised, they clap for them. They're like, oh my gosh, you're the greatest, right? This is amazing. And their stock prices appreciate quite a bit, right? This student, it's like panic and the stock gets sold off very hard. So that's just kind of a real world of, kind of thinking about this overall, okay? Very important. Tip number 4 of 10, balance sheet is vital in so many ways. Sometimes, a lot of people don't even look at balance sheet when they invest, and they just make these huge mistakes. Balance sheet is so vital for so many different reasons, okay? Some of the main reasons it's important to have a good balance sheet company, right? In the way I think about good balance sheet, high cash, high investments, low debt, okay? So high cash, low debt, or no debt means lower risk in bad times, right? If you're going to go through a big recession or something like that, which recessions, they happen. Every 5-10 years, you have a big recession, right? Or some sort of recession. In those sort of tough times or high inflationary environment or something like that, right? You want to be in companies that have a lot of cash in low debt or no debt, right? Because they're going to be able to get through to the other side. Even if the company had to start taking some losses in the short term or their profitability got hit, they'd be able to make it out to the other side. So when the recession's over, they're still around, right? Now, high cash, low debt also means big interest income when we got rates high. And I'll give you a real world example in just a moment of a stock that's been making a lot of interest income and they don't have to deal with interest expense. High cash, low debt also means you can buy competitors in good times or bad times, right? So if you're going through a recession, you can buy out your competitors because you got a lot of cash around and you got low or no debt, right? If you're in good times and you see a competitor that's attractive pricing, you can buy those. Now, the inverse is also true, right? So let's say you got low cash, high debt. Well, guess what? Now you're at higher risk in bad times. Let's say you have low cash, high debt. Now, instead of interest income in high rate times, now you're paying big interest expense, right? Which is going to hurt your profitability of your company. Let's say you have low cash and high debt. Now you can't even buy your competitors in good or bad time because you're in a bad financial situation, right? If I give you one of the best examples of a great balance sheet company, it would be Palantir. And because the balance sheet's so good, it helps their income statement as well, which is tremendous. Because if you have such a great balance sheet, it can actually help your income statement. If you have a really bad balance sheet, it can actually hurt your income statement, okay? So Palantir is a company that's loaded with cash and investments and no debt on that company, right? And because of this, the billions of dollars of cash, they're able to put that in treasuries. And they're able to generate a massive amount of interest income. If there's any Palantir shareholders watching this video right now, let me know in the comments section, okay? You know about this. They generate a ton of interest income. And so basically, if you look at their operating income was $65 million. But yet their earnings from continuing operations was $96 million, almost $97 million. The reason is because of that interest income. It helps the company. Now think about this. If, let's say it was opposite situation. The company was debt loaded like crazy, right? And they had little to no cash, well, then they would have a massive interest expense. So that could even put the company into a situation where maybe they wouldn't be profitable right now, which is incredible to think, right? From nearly $100 million of profit in the latest quarter to think about if they were opposite situation balance sheet wise, they could potentially not even be profitable at all. This is why balance sheet matters so much. Now, financial statements wise, if you need help understanding those on a high level, income statements, balance sheets, cash flows, all those sorts of things, these metrics, apply to join my private group. That will be the pinned comment down there. The Becoming Master Stock Market course goes a lot into that. This one will help you out tremendously as well. Financial statements and stock market mastery will help you out. We even have some CPAs going through some different financial statements to teach you there, not just me as well. And then high level company analysis, that particular course series will help you out tremendously, okay? That's pinned comment down there if you want to apply to join in there and learn at a much, much higher level, okay? Tip number 5 of 10, don't let shiny objects distract you when you're on the path to $1 million plus, okay? So let's say you're climbing the ranks, you're doing well with investing, you're putting in the work, you're getting success, right? You're depositing every month, one time or multiple times. Okay, awesome. So you build up to $100,000, but then you're like, oh man, I really want this car. So you go spend $50,000 on that new car, right? Okay, you're just gonna understand you just took yourself back in time several years. Because now you have to build back up so that you went from $100,000 down to $50,000 invested, right? So now you have to worry about building back up just to get to $100,000. Now, that's going to take you years to probably get back to that sort of level unless your income's crazy, right? If your income's like ridiculous versus your expenses, then you can build up there in like a year or less, right? But if you're not in that situation, which most people aren't, it's going to take you probably 2 to 4 years just to build back to where you used to be. Now, think about it. In that 2 to 4 years, if you were at $100,000, then you probably scaled up to $150,000 to $200,000 by that point in time. So if you just waited a little bit of time there, you could have played that smarter, right? And you wouldn't have put yourself so far behind. You want to get yourself to a place where your investments start generating you so much money in terms of the gains they're giving you and the dividends you're receiving that whatever you spend money on is just such small amounts of money in the end, okay? The goal should be to never take money really out of your investment accounts until you've built it up to such incredible levels that it's like it's okay if you do it, right? The only logical reason when you're on the climb, right, to $1 million or several $1 million in your portfolio, the only logical reason really to pull money out should be real estate. If you're going to buy a home for yourself and you need to make a down payment, I can understand, okay? And also real estate's an investment, so that's fair play, right? It should appreciate over the next 5, 10, 15, 20 years very nicely, right? And so that makes sense. That should really be the only excuse, in my opinion, to pull substantial amounts of money. Anything else, let's say you want to use a down payment on a car, you should use that out of your income versus expenses. Let's say you want to go on a vacation, you should use that as your income versus expenses. You shouldn't really be, pulling money out of your stock market portfolio really unless it's this sort of situation, okay? So that's very important. Tip number 6 of these 10, let great companies be great, okay? Let great companies be great. Do not be in a rush to take profits after you made a little bit of money. And I understand everybody falls in this trap, but especially a lot of newer investors because you haven't been in the market for a long time. Sometimes you make 10%, 20% on a stock and you're like, oh my gosh, I've made so much on the stock so short. And you're very quick to take those profits, right? If you want a truly great company, let it play out. Let it play out. Don't be in a rush to take the little money, okay? Chase the loaf of bread, not the breadcrumbs, right? Howard Marks, this is a phenomenal thing he said, okay? He said, day traders consider themselves successful if they bought a stock at $10 and sold it for $11, and then bought it back the next week at $24 and sold it at $25, and then bought it a week later at $39 and sold it for $40, right? And sure, that sounds successful. You made 3 successful trades there, right? If you can't see the flaw in this, that the trader made $3 in a stock that appreciated by $30, you probably shouldn't read the rest of his book he put in there, right? Which is phenomenal. It's 100% true, right? And so you don't want to be this guy who thinks you're being successful because you're taking a little bit of money here and there. Great companies, you got to let them be great, right? If we look at the public count, I have some stocks in there just some ridiculous gains, right? 2,100% plus on ELF, 500+% on Tesla, 300+% on Meta, 155%. And sure, is it tempting sometimes to say, oh, let me take a profit on this stock or that stock? Yeah, sure. But I understand I own truly great companies, and I got to let these companies be great. These sorts of companies are freaking amazing, okay? Let great companies be great. Chase a loaf of bread, not the breadcrumbs. If you want the big loaf of bread at the end of the pie, you gotta go for the loaf, okay? The breadcrumbs aren't gonna get you there. Number 7 of these 10 tips is around selling stocks. You should really only sell a stock for 3 reasons, okay? First reason is it's a situation, and these are kind of all in the same in terms of this first category. It's you screwed up, right? You bought a bad company, the fundamentals changed, something like that, and you're like, I gotta get out of this thing. The company's going downhill. It's not what I thought it was. You made a mistake, right? And you're going to make mistakes. I didn't put that as one of the tips, but you're going to make mistakes. No one gets 100% right in the stock market, and be okay with that. You're going to fail. You're going to screw up. You're going to make some bad investments. As long as you're right a lot more than you're wrong on these stocks, it's all that matters in the end. It's all that matters. The fact that you get this stock wrong, that stock wrong, who cares? It all is irrelevant in the end. It's all irrelevant. As long as you got things right a lot more than you got wrong, especially about your big investments, that's all that ends up mattering in the end, okay? So I just want to say that. Do not be afraid of failure. In everything, you always fail. In your job, you're going to fail sometimes. If you run a business, you're going to fail sometimes. If you play a sport, you're going to fail sometimes. It doesn't mean you're still not successful. You can be incredibly successful even with failing. Everybody fails. The greatest, Tiger Woods failed. Michael Jordan failed. Tom Brady failed. Adele failed. Beyonce failed. Taylor Swift failed. They all failed. And yet, look at the tremendous amount of success because they had a lot more success when they had failures, right? Okay? So, that's a situation where you just screwed up and you're like, dang, I got it wrong. I need to move on. That's a reason to sell. Number 2 is if a stock is very overvalued versus the future growth of that company, which is fair, right? Sometimes you get into a company and the valuation just goes to ridiculous levels and you're looking at future growth over the coming years and this doesn't make sense, right? A good example of that was Tesla for me several years ago. 3 years ago, Tesla got to $1 trillion plus valuation, and I looked at kind of where future growth was likely going over the coming years, and I said, this might be a time I actually have to take some profits on Tesla, and I did. I took a lot of my profits on Tesla back then, right? And it made sense. I think the situation is different now. I think Tesla's actually a very attractive buy, but 3 years ago, it wasn't a very attractive buy because the valuation had run up to such an insane level for where the growth was going, in my opinion, over the coming years. It made sense to cash some shares there. So sometimes that's the situation. You're just looking and you're like, the forward P is insane. The valuation's insane for where future growth is, right? And so it's just priced in too much good news for the future. Third thing is, if you have a much better place to put the money. Sometimes you just got a better place to put the money, right? And so that's another reason to sell as well there, okay? Tip number 8 of these 10 is try to only sell for a profit if you've held longer than 1 year, okay? It's extremely important. This can completely alter your gains over time, how you compound money because of what's called taxes, okay, in the tax man. This is straight from the IRS website, the Internal Revenue Service, okay? Net capital gains are taxed at different rates depending upon overall taxable income, although some of the net capital gain may be taxed as 0. For taxable years beginning in 2023, the tax rate on most net capital gains is no higher than 15% for most individuals, okay? Now, this is important. You want to hold a stock for ideally a year or longer because you're going to be taxed at way less. A capital gains rate of 0 applies if your taxable income is in these brackets here: $44,000 for single, $89,000 for married, right? A capital gains rate of 15% applies if your taxable income is more than 44 but less than a half mil, right? You're just going to pay way less taxes, because here's the deal. If you sell, let's say you hold a stock for 6 months and then sell, okay, now that's going to count toward your ordinary income. Well, guess what? Most people's ordinary income tax rates are in the 20s or 30s. So most of you guys watching this right now, your ordinary tax rate is in the 20s and 30s. So if you sold a stock for, let's say, that you held for 10 months for a gain, now you're going to be taxed at, let's say, a 27%, versus if you held that stock for a full year, let's call it a couple months longer, right? You'd be taxed at either 0% or likely 15%. That's a much, much better situation, okay? So very important in regards to the taxes. You can speak to any tax person about that, and they'll tell you the same exact thing I just told you there, okay? Tip number 9 of these 10 is, if you're buying a company that has a net loss company, it's dangerous. If you're buying a net income company, meaning they're actually profitable, it's a far safer company, okay? Doesn't mean you can't lose money potentially if you buy a stock that is a net income company, but it's much safer. Many of the net loss companies in the stock market, you got to understand, they go bankrupt or they get stuck in the gulag. The gulag is essentially a situation where a stock goes under $5 and then stays under $5, which it stays into that, let's call it the penny stock category. Now, the last tip here, number 10 of 10, is staying diversified is your alpha long term. Bear markets expose portfolios. Bear markets meaning essentially those markets that you see a big correction, a crash, which happen every few years, right? Those ruin portfolios that are not diversified, or portfolios that are on margin, okay? Margin essentially meaning you're investing money that's not really yours, you're investing debt. This can absolutely destroy a portfolio. I'm sure there's plenty of people out there in 2022 that got their portfolios completely wrecked because they were not diversified enough, they were not into enough high quality companies. I'm sure that happened to a lot of people in the great financial crisis in 2008, 2009. I'm sure that happened in the 2020 crash, right? That took a lot of people, caught a lot of people off guard that were on margin or not diversified enough. And so you got to understand, being diversified, owning many different great stocks across different categories, is going to give you so much more protection. I talk about GVD a lot, growth, value, dividends, owning growth stocks, owning value stocks, and dividend stocks. Where a lot of people get into trouble is they only own one group and they could end up underperforming the market significantly. If, let's say, growth stocks out of favor for a while because you're in a recession, that's going to be tough. If, let's say, you're all in dividend stocks in a market that things are rolling and you're watching tech stocks go up 30%, 50%, 100% in a year, while you're there sitting there collecting your 3% in the dividend stock and getting hardly any appreciation, then you're not in too good of a situation. That's why you got to combine all categories together, understand how to identify great growth stocks, able to identify great value stocks and dividend stocks, take advantage of those opportunities and build out your portfolio that way. And then you can get the best of the best in all those categories. You can get the best of the best growth stocks, the best of the best value stocks, and the best of the best dividend stocks. People like to try to just put themselves in one category, but usually it's because they're lazy. They don't want to put in the actual work, right? And if we look at the public account, there's such a great diversified portfolio, right? Now, Meta is obviously a huge position here, but it's not a huge position because I put that much money into it, right? It became such a huge position because it's up to $676,000 gain on Meta stock. That's why it became such a big position. But overall, if you look at the portfolio, it's very diversified. I own Meta, which obviously is advertising. Tesla, which we can call it, vehicles and energy, right? PayPal, which we can call, fintech. Amazon, which would be e-commerce plus the internet with AWS, right, and cloud, and advertising. Elf is cosmetics. Palantir is, we can put it more into the SaaS category, right? Revolve, we call it e-commerce clothing company. Cake is a restaurant. Nike is an apparel company and brand, right? NVIDIA is a semiconductor company. The Planet is a Jack Jackson company. SoFi is a bank. Fubo is a streaming company, right? And then I got some hedges on for that portfolio as well, just in case things go south. So this is an overall very well diversified portfolio across several different industries, and it's a portfolio that's whether it's ready for whatever. Bull markets, bear markets, let's call it kangaroo markets that aren't really going anywhere. It's ready for whatever, okay? If you want to learn how to build your portfolios into ready for whatever in your focus on scaling, getting serious about this game, apply to join my private group down there. That is going to be the pinned comment. You get access to all my course curriculums. You get access to the 6 and 7 figure Discord chat, and access to see the moves I'm making each and every week in my portfolios as well. So it's tremendous value. And yeah, if you're serious about this game, you can go ahead and apply to join us in there. There's a reason we've had so many people have incredible levels of success that have gone through the program over time. Okay, much love, folks, and have a great day.